Are you worried about the yield curve inversion?
No, normally the ones that precede recessions, it's because the short-term rates move higher when the Fed's tightening. This has been different. This is a case of the long-term rates coming down, and looks like a pretty crowded trade to me, where people are worried about a slowdown. They're buying long-term bonds, seeking safety. Feels like we've been through this many times during this 10-year bull market. We have, for sure. This just maybe represents a new breach. Brian, I know in some ways you also think it's different this time. You think that we heard what Joe Lavorgna said, an inverted yield curve, banks, it creates a problem for them. But you're saying that that's not the whole story, is it?
It's not, because in the past, other yield curves followed along with the Treasury curve. This time, other yield curves are behaving in different fashions. The one that banks use, the Fannie and Freddie curve, that's actually still positive. And if you look at the ones that shadow bankers use, let's say LIBOR versus corporate bonds, that's actually steepened to the steepest in almost 4 years. So we're actually going to probably see an increase in shadow banking, which means more buybacks and more mergers that'll get stocks up once this panic ends, probably sometime next month.
Brian, so when people say to you, hey, look, I don't want to hear explanations that this time's different and so forth, you've been in these markets for so long. How confident are you that these dynamics are really different this time?
Well, I wrote a column yesterday titled, Investors Have to Look at Yield Curves the way shadow bankers do. Because shadow banking, in other words, non-traditional banking, the things we did with WorldCom and Enron, that's more attractive now than it was 6 months ago. Those are the flows that have been driving this credit boom and this bull market, and they're going to intensify in the next year or so based on what those yield curves are doing.
You think we're multiple years, 2, 3, 4 years out from a credit crisis and recession, not 18 months?
If you look at forward LIBOR, which is measured by Eurodollar futures, the most liquid, heavily traded futures contracts in the world, they're telling you that there's a series of rate cuts coming for the next 2 years. And that curve is steeper now, which is telling you that those investors who are closest to the economy think the global economy is going to slow, that inflation is going to go down. And if the Fed finally responds to that, that's going to lead to a very positive environment. The same thing that happened at the start of this year when your show debuted, the Fed turned around, caught up with the market, and we were off to the races. Yeah, and that was just as you had described. So, Sandy, meanwhile, you're looking at a couple of names in particular, kind of like Craig, where you say, I can still find value in this market. Stocks still look okay to me. Talk through that strategy.
Yeah, so we're always looking for value in this market. We love growthy names, but we love reasonable prices. And so, with the market hitting strangely all-time highs just the end of July, it's tough to find those bargains. But we see a lot of value in a name called Abiomed that we really like. Another company called On Semiconductor, and Teleflex, another company that we like a lot that we think you can buy in this volatile environment.
But you do have a higher cash amount than normal, is that right?
Yeah, we're up as high as 20%, which is more cash than we've held in some time. And again, it's not because we think we're going into some sort of deep recession or something like that. We're just not seeing the stocks that we want to buy at the reasonable prices. So, I'd advise investors to have that laundry list of great high-quality companies and buy them in these dips. I think that's going to serve you really, really well looking out 2 or 3 years.